All right, guys. Today we have on Lucas from World Markets.
Yes, sir.
Wait, yeah, I wanted to say World Capital Markets, but World Markets. And then Hersch, well-known God tier shit poster, one of my favorite accounts to follow, who is working with World Markets on go-to-market and business development. So welcome, Lucas. Give us a little bit of background. We're going to spend more time on your background because I think people are going to find it really interesting. But yeah, just give us like brief overview, and then Hersch, you can do the same after.
So I started my first crypto company in 2017. That was a derivatives exchange backed by Susquehanna, the headquarters in Philadelphia. And we sold that business to Amber Group in 2021. And the business was, from a technical perspective, on-chain custody, on-chain settlement, off-chain matching, which is what any engineer will tell you should build if you want to have kind of a trustless setup without sacrificing performance. And the really counterintuitive insight in that business, which we had like 2.5, 3 years into building it. And, at peak, we had 60 employees, 40 full-time engineers, very smart people with PhDs, et cetera. There is a relationship between state synchronization and the risk calculation, which, without all the technical jargon really means the following. If you want your users to make as much money as possible for a certain risk profile, like a given risk profile, then you actually have to build an entirely centralized or an entirely on-chain architecture, including the matching engine. So that's super counterintuitive. And it's with that insight that World Markets was created. So in 2022, we started thinking about where the exchange space would end up in terms of crypto. And that insight and kind of the conclusion, suggests that either we need to build something centralized like Hyperliquid and kind of what they did starting around a similar time, or we need to kind of adapt our view of the world and believe that eventually the EVM will get fast and cheap enough to support a fully on-chain DEX with all the functionality that is really required for proper usage. And we went with the latter approach, not knowing whether it would be 2 years or 10 years. We started a hedge fund in parallel that does, stay reasonably successful and does a lot of trading in DeFi and CeFi. And then eventually, we actually first learned about Monad and kind of joined the Monad ecosystem and kind of really started to understand more about their technology and their ecosystem. And then members of the same team met MegaETH and really started to lean into like MegaETH's core technology and value proposition and comparing the two. And when we fully understood what MegaETH was doing, we decided like now's the time to launch the business. And because, they have the technology that kind of fulfills this thesis. And so that's how World Markets was born.
So wait, just quickly, since you're on this topic, you said you initially were looking at Monad and then decided on MegaETH. What was the rationale there? And like, tell me if I'm incorrect in believing this, but was the thinking that it's just much more difficult when there's a decentralized validator set versus a single sequencer to do what you wanted to do, or is there more to it than that?
So there are really two parts of the puzzle. One is ecosystem and two is technology. Technology really being the priority for us because the success of an ecosystem is very hard to bet on. There are just so many more kind of external variables. Whereas as long as the technology works to the level we need it to, the ecosystem can actually fail and we would still have a business. So the first thing on the technology side was that we actually believe in the L2 thesis, meaning that if you're in L1, there's this dilemma between the apps and the token holders because the network token is also the gas token. So token price goes up, you benefit the investors, but at the expense of the apps, vice versa. You could also benefit the apps at the expense of the investors. L2s don't have that dilemma because the gas token is not the network token. So that was a really big one. And kind of then tying into the ecosystem, when we would ask Monad folks these questions, it felt like we were like punished actually for asking things. I don't want to get too much into sort of the kind of experience there, but it wasn't an especially like kind of open and honest experience. And then on the other thing is like just speed and cost. So MegaETH is, a heck of a lot faster. And obviously that's because Monad is running more decentralized than MegaETH is. But we felt that trade-off made sense, given kind of, our business model. And then, the ecosystem, MegaETH ecosystem is, everybody can form their own view. In my view, it's meaningfully better. And so that was kind of a cherry on top. Working with Elong and Chu and Namek and Amir and kind of the rest of the eco team has been really good.
Okay, so then let's go back to your trading experience. What were you trading? You said you ran a hedge fund. So wait, just for a little bit of context, you said you sold your business to Amber Group. Was that the hedge fund?
Yeah, that's right.
Okay,
no,
what was
that? Was the derivatives exchange.
Okay, got it. All right, and so then you started a hedge fund, and for the past
that's right.
5 years you've been trading on chain.
Yeah, we approximately maybe 4. So we started prop. We started really building. This is a rabbit hole. I'll give you kind of the
go down it. Go down it.
Whether we go. So we started building trading infrastructure because I actually wanted to start a hedge fund in 2022, and the CEO of my first company wanted to do it together and kind of called me. So we started looking into it and found that the infrastructure was so primitive for DeFi trading that it actually made more sense to start a tech business and then service these future clients. And really where that business ended up was we started focusing on security. So here's the crazy thing about DeFi trading, which is true today, by the way. Every firm that operates on chain, almost every firm, I would say 9 out of 10, maybe 19 out of 20, runs the avoidable risk of losing basically all of the money at any given time, not due to a protocol hack, but due to transaction security, which is this topic that everybody seems to ignore. So what I mean by that is the most popular custodian for DeFi historically and today is Fireblocks for institutions.
Yeah.
If you go into Fireblocks' policy engine, this has been true forever. It's true today. It's nuts. And you set Uniswap, let's say you're trading on Uniswap, right? And you go into a policy engine and you say, okay, well, this trader can trade on Binance, but they can't trade more than this amount of money. They can't withdraw, whatever it is, right? You set those settings. And you do the same thing on Uniswap, even though it allows you to set the settings. It doesn't enforce it. So you can literally just steal all the money as a trader. Or if it's automated trading, which it usually is, then you just inject a bug in the code, or you could click the wrong button. So, and the way you do it is what the policy engine checks, and they now have a manual kind of side process to try and prevent this, but it's also, I just think the whole thing's a joke. But the policy engine checks is the from field and the to field of the transaction. So it says, okay, is the transaction coming from the wallet? Yes. All right, good. Is it going to Uniswap? Yes. Okay, no problem. And then it totally ignores the instruction set. So the instruction set could say, okay, when it gets to Uniswap and does the swap from A to B, right? Set the recipient address of the swap, which is a parameter in the function, to my private wallet. So I'm swapping A for B. Send all of B to my private wallet. You can do that, and Fireblocks doesn't check. Yeah.
Interesting.
So we built a solution to that problem. And I went around to plus the trading tech. And eventually went around the market, and it was a pretty crazy experience because you would think that that would just sell off the shelf. What I realized kind of, after doing that for a number of months is that the reason Fireblocks doesn't solve the problem is because the market for it is so small. There historically have been about 20 businesses that actually trade on chain. And it's really more like 10 with another 10 as a buffer globally, period. Recently, that number has been increasing materially because of the recent bull run. But from 2022 to 2024, say early mid, it was nobody.
Okay, so
and the firms who did trade on chain, There's a rabbit hole, by the way.
No, it's interesting, but let me interrupt for a second, just like again to provide more context as we now lead into what you're building now. When you say you're trading on chain, like talk to me about what type of strategies that looks like. Like, were you doing sex to XR? Were you doing NEV stuff? Were you doing like latency? Like
all
what?
of it.
Okay, so you're trading like, just for some like interesting background, like you are trading against like Wintermute and SEP and all of these guys on chain. Okay, got it. And what was like so when you started this hedge fund, in your mind, you were looking at the market and say this is wildly inefficient because it runs 12 seconds behind, the real world. What was in your mind, like what was the big alpha you had? Like what made you successful, just out of curiosity, with like, trading on chain?
Yeah, that's a great question. So it's a combination of two things. One is that we are pretty technical. So I was the CEO of the company. So everybody else on the team is like way more technical than I am. And I was the CTO of my first company, which wrote the largest Ethereum code base globally, the derivatives exchange. At least to my knowledge, I think that was validated by Consensus Diligence at the time. And then our approach was a little different. So we run what's called a multi-manager hedge fund, which is
like, is this a prop shop?
We started out prop and then we launched it as a fund.
Oh, sorry. But is this a pod shop? Is it like that, the equivalent for? Okay,
yeah, that's exactly right.
Okay, go on.
So we actually we have internal trading, but really where we basically don't invest in that. So more for all practical purposes, like we've done internal trading. But the way the business evolved is we actually stopped the internal trading or did it on only small sizes and spent all of our resources on sourcing every single trading team in crypto, CeFi or DeFi, and then onboarding them onto our infrastructure to capture the alpha and run the strategy on our infrastructure, legal and technical. And that creates this kind of diversified portfolio where it flattens volatility. And then finding like cheap sources of capital to apply leverage to the portfolio as a whole. And nobody had done that with any kind of, almost nobody's did that in crypto period, but like, especially within DeFi, right? Like nobody had done that in DeFi. And so because we were able to get this like unique view on the market as a whole, because I know what every trading team is doing, that's willing to take capital. But I don't know what SCP is doing, right? They're not going to take capital from us. But say you're like, like Subway, right? We can work with them specifically, but your 3 to 5 man MEV shop. I know what all those guys do, like down to the wire. And when you can kind of like cross pollinate and like, if we're all starting like HFT on centralized trading, we can start to combine those. And that was sort of our edge and still is today.
Okay, wait. So just one last thing. Is the hedge fund still active?
It is. It has a full-time team, full-time co-founders that don't do anything world markets related.
Got it. Did you have experience in TradFi?
My first company, the reason that I have sort of TradFi knowledge is because I just got exceptionally lucky is the honest answer.
I think a lot of us did.
Yeah, right. I'll give a very brief version of my life story, not to get too deep into this topic, but I was born in North Carolina in like a really small town. So, dad had like a construction crew, about 5 people. And my mom was a stay-at-home mom originally, and then just get a little bit more household income, became the equivalent of like a school teacher, like 3,000, people in my town. And I moved to Germany on a government scholarship as a teenager, just because I wanted to kind of leave. And then moved to Morocco, learned Arabic just for the fucking giggles. And then moved to Hong Kong for college because I wanted to, basically, like, I went to school for computer science. They offered me a scholarship. I wanted to go to school in Asia because I'd never been there. At the time, it was like, I felt like I hadn't learned anything in school, and I learned a lot living abroad. And so it was like, let's just do more of that. And I didn't have to pay tuition or boarding, so it's like fucking just kind of a no-brainer. Really transformative sort of experience. And so what's crazy is when I was a sophomore or a junior in college, I was an early adopter to like blockchain tech at a time when everybody was sort of LARPing about it, but nobody knew what the fuck it did. And because Hong Kong is a little small and I had unique knowledge of the technology, I was for a little while, I was like the guy in Hong Kong, or one of the main guys who understood blockchain tech. And if the thing about Hong Kong is that it has very limited technical capabilities, but the financial industry is booming and financial services, et cetera. So my first company, like the CEO and my co-founder, essentially brought Goldman Sachs to Asia. Like he was a partner at Goldman for a long time. His boss was the president of Goldman Asia. He was co-head of distribution, so head of sales for Goldman Asia, I think, like ex Japan. PhD at U Chicago in finance, and just a resume and background and credibility that I had never seen before, much less like worked with. And then he brought on 2 tenured chaired professors at Harvard who created Harvard's like fintech program, and like when you hang out with them, like 20% of the conversation is like they're mutual friends who have Nobel Prizes in economics. So like, and like I just fell in because I'm like the fucking crypto kid tech guy, right? And so, I was just lucky enough to kind of like that serendipity happened. And I worked fucking hard. I slept 4 hours, like at most 4 hours at a time for years, because I was worried that like too much in the world would happen while I was sleeping for me to like keep up with it and like take advantage and like, execute on the business side, which I think they saw and they were like, Jesus Christ, this kid, like, they're like, when do you sleep? So I learned everything traditional markets related from them. Obviously asked a heck of a lot of questions. And so even though I've never worked in traditional markets, like our BD team was like Goldman Partners and MDs and kind of all this stuff. And it was hilarious is like, I have friends from college who like went into investment, who like work at Goldman. Now they've worked at Goldman for like 10 years.
Yeah.
And they have like the thing about finance is that it's actually shockingly simple. It's one of the simplest industries I think like I've ever seen, but it's also like, it's deceptively simple, meaning that there are 1,000 ways to do something and 5 of them are right. And if you don't know if you haven't like talked to the person or read the research, understood the literature, if you don't know the history of the evolution of financial markets, you don't know those 5 ways. And I can give a lot of examples in DeFi and CeFi. So it's deceptively simple, but if you know kind of how things are properly structured, then it's actually not that hard to understand.
Okay, so then that now we can kind of come into what you're working on now. So what was then the motivation for world? Well, first of all, explain world markets, because I've done a number of, so I've done actually a podcast with like seemingly everybody building a perp dex right now at this point. So it's right, it's like quite a competitive environment, and everybody is, I think, competing on fairly like similar dimensions. But it does seem that you, like, part of the reason that I wanted to have you on is because I think you guys are doing something somewhat unique. So like, talk to me about like world markets and then what the kind of design of it is and what you're hoping to achieve. Yeah,
and I totally agree. So the funny thing about the origin story is like, so after selling to Amber in 2021, I took a step back from crypto because, it can be sometimes you're like, is it worth it, right? Like, are we really saving the world here? And I looked at quantum computing because I thought that was, and I built some like, kind of like circuits on like IBM's quantum computer. I looked at brain machine interface, in the medical applications. And, I thought to myself, like, what business can I build which kind of moves humanity forward and is also like relatively unoccupied from a competitive advantage, right? Like, I don't want other people sort of just working on the same fucking thing. And the obvious answer, if you just look at kind of the world as a whole, is humanity really needs another fucking perp dex. That was the only like
I could not agree more.
So yeah, right. It's like, Jesus fucking Christ. So world markets, it's perps, spot, and lending, all on one venue under a unified risk engine, fully on chain, fully on order books. That's the product. The reason it's important is because users on world markets make more money for less risk than anywhere else in crypto, at least to my knowledge, conditional on there being a comparable level of liquidity. So you can't do anything about liquidity. As long as liquidity is there, there is no other venue in crypto where you're going to make more money more safely.
Let's dive into that. What does that mean in practice?
Right. There are 2 parts. there's a financial component and a technical component. I'll touch on the technical component briefly. Vitalik wrote this great article called Low Risk DeFi, basically saying that Ethereum's product market fit is, like Ethereum has at any given point a little bit north of like $100 billion of TVL, right? It's slow, expensive Ethereum, right? So what the fuck is all this money doing here? Well, it's because there's real product market fit in safety. Like, I don't care what you are buying. I don't care if it's milk at a grocery store. You're going to go to the grocery store where you have a lower chance of getting mugged, right? And Ethereum pushes the bounds on safety. So that's thing number uno, the technology and sort of the safety associated with being fully on-chain. Transparent, deterministic. There's no internal trading desk that's rugging you, blocking your orders, like so on and so forth. All right. Then there's the financial component of it, which is if you can correctly calculate risk, then you unlock additional returns for your users. And nobody's really done that yet. Binance has similar features, almost basically the same features actually, for certain markets where they own the asset. The in Sol, they're like the dollar and the ETH wrappers that they own. I believe Athena as well, USD. They don't offer this for markets where they don't own the asset because they're centralized and literally the fuck they want and that kind of thing. So we do. We offer it for Bitcoin, for Ethereum, for your majors. I can walk through a trade that would sort of illustrate that, but the simplest explanation or the simplest version is, let's say you're trading perps and you're doing it on a hyperliquid. Let's say you have $1,000. $1,000 just sits there. On world markets, you can lend that $1,000, get 7-8% interest, and use the loan as collateral to trade your perps. That's like the simplest example. You can then kind of layer in more complex examples and arbitrages on the exchange and cross exchange. But at its core, it's like correctly calculating risk, which has a bunch of dependencies that are very nuanced, which I'll kind of skip. But does that answer the question?
Yeah, I think so. I mean, if you want to like dive a little bit more into that, like I think so. Sure. My initial understanding is that this is, first of all, it's a form of cross margin. Is that correct? Like, or
that's right.
Yeah. And well, maybe talk a bit about that because that's something that people have wanted for quite a while and is only now, I think, on the current perp decks is really being implemented. And I think it's quite, well, it can be quite difficult from a risk profile if you're allowing like just all of the assets to be collateral at once. It really kind of like can create this house of cards dynamic if the risk isn't really well implemented. So maybe talk a bit about that. And also, like, am I correct in saying that's sort of the reason why this hasn't taken off yet on dexes specifically?
Yeah. So I'll start with the first question. But yeah, your intuition is exactly right. So cross margin, as it's implemented today, this allows you to take your unrealized P&L from one perp and use it as collateral for another perp. That's the whole thing. It also means that if one position triggers a liquidation, it will liquidate all of your positions, and that's the risk. So that is, now if you take that core concept, you've introduced more capital efficiency than isolated margin. Now, where it gets really interesting, and I'll kind of tell you why I think the risk of this like liquidation risk is like something that is like, I don't say easy to mitigate, but you'll kind of see where I'm going. So if you take that core concept and you expand it to lending, perp, spot, etc., some categorically new things happen, right? So on world markets, if you do the basis trade, you can make 50% returns, 50, for very little risk. And at least I think almost everybody would say very little risk. It's not risk-free, but it is low risk for sure. On Hyperliquid, you can make, if you're lucky, like 7% on the same trade. So the unlock is meaningful. Now, how do you then, what about liquidations? How do you kind of like manage that? The first thing is that the liquidation levels on world markets are lower if you're long than Hyperliquid, meaning that they're safer. So, and the reason is because like if I'm long ETH, let's say I'm short ETH perps and I hold ETH spot, world markets understands that they have the same underlying asset and will then like only factor in your net exposure, or it will primarily factor in your net exposure to the asset and your risk calculation. So the liquidation price on your perp, let's say that you're long, if you're using isolated, I'm just making up some numbers here, but ETH may be trading at like 3,000, and it's pretty typical for your liquidation price to be like 2,900, 2,800, right? If you're long ETH. Let's say you're like reasonably collateralized. On world markets, if you hold ETH spot on Hyperliquid, like that's how that works. On world markets, if you're long ETH and you hold ETH spot, your liquidation price is going to be like $500. Like ETH has to hit $500 to get liquidated. It's like none. Like the chance is very low of that happening. So, and then the other thing is, like where I think the market will evolve is with isolated margin, every trade is separate. And if you're trading meme coins, like that's probably where what you want to do, or like super like crazy stuff. But if you're trading the majors, or even just kind of like higher quality assets that aren't going to zero, what you really want is something in the middle, meaning like you probably want cross margin as like the default feature, but you want to separate your portfolios into different accounts, either different sub accounts or different wallets, so that you're like, maybe this is like these, this set of stuff. Maybe this trade, I just want isolated. So I'm just going to like throw it in this account, right? Give it a little bit of collateral. These two trades, they're correlated or they're anti-correlated. And so I'm going to package them together because like, that isolates the risk, right? And like, it's unlikely that they'll get liquidated. You see what I'm saying?
Yeah.
That configuration is actually like how you're going to manage your risk and kind of what people do in traditional markets.
Let me take a moment to talk to you about Ellipsis Labs, a team I've known for a while building some of the most interesting products in the space. The Ellipsis team is one of the few that I can consistently point to and say, these guys really know what they're doing. They're backed by Paradigm, Electric Capital, and Han Ventures. The founders, Eugene and Jerry, have experience at Citadel, Jane Street, and the Solana core team. Since launching their order book DEX, Phoenix, they've done over $80 billion in trading volume by making on-chain order books competitive with centralized exchanges. They are also the team behind Gavel and SolFi. I would consider them the foremost experts in crypto market microstructure. The best part is Ellipsis is hiring for New York-based engineers. Work with a small, focused team who are results-driven, collaborative, and use a modern stack. If you're an engineer who wants to work on infrastructure that's already proving itself in the market, go to ellipsislabs.xyz. Okay, now back to the show.
I heard you talking also about ADL, circuit breakers, maybe a little bit of like talking about 1010, what happened. First of all, I want to ask, since you ran a hedge fund, now stepped away, but we're very much involved in this domain. What do you think like about 1010 and how it was handled? I mean, was there anything? So obviously there's rumors, and then I've heard. I think obviously second or third hand, but I've also heard from slightly more credible / substantiated sources that there was some real shenanigans going on some of these centralized exchanges potentially. Do you have any thoughts or insight there?
Yeah, I think that 1010 was just a perfect illustration of why centralized exchange trading is fucked. And like, here's what people don't fully understand. Centralized exchange trading is not fucked because the exchanges are untrustworthy. Like, yeah, that is a big fucking problem, and that's definitely true in my mind. And it depends on the exchange, but on the whole, that's true. Centralized trading is fucked because it's like actually more fucked than people think. So once you get into like the really like the more sophisticated stuff, which is the prime brokers and the off exchange clearing and credit lines and like working with different lenders and LP, like trading really professionally in the centralized exchange world or just the centralized world, it is like let me give you an example. So I won't say who this is so I can say more about it, but
good. I like it.
Two funny, one, the fund does not put capital on exchange. It's actually in our mandate as a requirement of our LPs that we only use off-exchange settlement because of FTX, right? And sort of the broader concerns. So the way that works is we actually borrow capital and put the borrowed capital on the exchange. And typically the lender takes that risk, and we pay the lender to take the risk. One of the main prime brokers we use, and are actually like kind of the prime broker for crypto at the moment, I won't say who, like I at least 25% of the time, no, maybe that's a little bit much, 20% of the time, 15-20% of the time, they have no money to lend us. And the accounts are in their name. What that means is like, when we need to trade, like, hey, we need to move, we need to like, whatever, it's like our fucking job to trade. We need to move capital into this account so that we can like get up this arbitrage strategy or whatever. They're like, sorry guys, we can't give you any money. So then the next obvious question is, well, what if we just give you the money to give to us? Right.
And then they just take the risk, right? It's almost like an insurance policy.
Yeah, they still can't do it. Like, we can't give them the money to then put in our account.
Okay, wait, let me ask you something.
Because operationally, they are not capable of doing that.
Is this standard? Like, are all the big trading firms using this?
It's so fucked. It's crazy.
This is so weird.
And then
so wait,
this is what nobody talks about, because the worlds are like bifurcated. You're either in the centralized exchange world doing this kind of shit, or you're in DeFi. Nobody kind of sees into the other. At least not with this level of granularity.
So wait, like, let me just like reiterate this for me. Trading firms go to a prime broker who you guys set. Wait, so do you send them money? You don't send them money first, but they take the risk on the exchange.
We give them collateral.
Okay, you give them collateral and they hold it somewhere in a separate account. And then you are then allowed to effectively trade their capital through your own account on the exchange.
Using our collateral. That's right.
That is super bizarre. That seems like one of the most like inefficient.
Yeah, that's how it works.
Unnecessarily like intermediated system. So in the rationale behind that is because LPs literally are not willing to accept the exchange risk, moving large sums of money on. Correct. So like, but that's really bizarre.
Multi-billion-dollar New York hedge funds are like, fuck this, no chance.
Really, that's fascinating. So they won't even. They basically don't trust Binance. I mean, I'm
no fuck
maybe
Jesus.
Yeah, at all. Wow.
I mean, it depends on who they are. Like, Asian LPs tend to trust Binance a lot. New York LPs, if they're very crypto native, like most of them do, some of them don't. But if they're running like $20 billion, which by the way doesn't exist in crypto, and this is like some whatever the fuck percentage of their portfolio, and they want to kind of see what happens, no, fuck no, not a chance.
That's fascinating. So, but to contrast this, you can deploy your own capital like no problem in DeFi, right? Like that you can just directly deploy it. Okay, are LPs okay with that risk? So if you have a trading strategy that employs like maybe SexDex or just purely on-chain, some type of arbitrage.
So this is kind of like case by case.
Yeah.
Like historically, these LPs are also not okay with DeFi. Right. They're kind of okay with it, but they're not okay with it at like some very large size.
Right.
So that's a totally fair point. I think the difference is that like the way counterparty risk gets managed is very different, and the kind of true nature of the counterparty risk is different. So the centralized exchange world, it will continue to evolve, but it's now been a while, right? Like FTX, we're now several years past FTX, and the industry was around several years leading up to FTX, and so it's kind of at the point where like it moves, but it moves slowly, and like it's going to be different in 10 years, but it's not like kind of cutting edge shit, right? So this is kind of what it's going to look like, maybe a little bit different like 10 years from now. And it can't change. There's nothing different about there's literally nothing different about the tech, the infrastructure, or anything. Whereas DeFi, it's less about like changing. I mean, the market structure definitely fucking needs to change, but I think that people are able. It's more about like people will get comfortable with the technology. Does that make sense?
Yeah.
It's not so much that like, So once people understand the tech, once people understand finance and they understand the industry and they understand, like the risk profile, they're like, no, fuck this. Right? Like it's not an understanding issue.
So let me give
DeFi, it's like, there's like $100 billion sitting in Safe, for example. There's $10 billion sitting in Morpho. Everybody can read the code. And if anybody, including the very well-paid people in North Korea, to find a vulnerability, they get to keep the money, right? They're like, okay, I see.
Okay, so let me give a slightly like a question leading coming from that.
Yeah.
So how do you think? Okay, so yeah, like everybody can read the code; it's verifiable, but you mentioned Morpho, which is like very different than Hyperliquid, right? So how do people respond to, for example, in your opinion, the Hyperliquid handling of 1010, ADL in general, and maybe also just to finish up, you can lead into your thoughts on circuit breakers and how you kind of think there are these, circuit breakers are just not really publicly available, especially on centralized exchanges.
Right. So, so Hyperliquid is totally centralized. It's no more decentralized than Binance. Now, Hyperliquid, what they did differently, and is a major contribution to the industry, is that they're extremely transparent. So they're not any more decentralized, but they are like categorically more transparent, and I would say like trustworthy on the whole. Now, it's good, but it's also kind of a problem because, like, they just stamp like DEX on their name, like I call it the glue theory, which you can just glue anything to your name. Like that's not going to like work forever. And so that's sort of the issue there. Now, going to like ADLs and circuit breakers. So the problem their transparency is self-reported data, right? And that's like the huge categorical difference from Morpho. Like I don't ever expect Hyperliquid, even though they've been incredibly successful, to have even a small percentage of the capital that Morpho has on it. They're going to have very, very high volumes because they're a perp DEX. But if you just look at like capital parked on the venue, like that's just never going to happen. And it's not because it's because Morpho is so much safer. That's always my perception. Now, eventually that capital needs to be more productive and people want to earn higher rates, and rates on Morpho are lower than like US Treasury bills, right? So that's an issue. Yeah. But from a safety perspective, Hyperliquid's never going to achieve like a Morpho level safety. Okay, so 1010, yeah. Like because these exchanges, centralized exchanges, are built like casinos, the core function that makes it a casino is that the exchange can take over your positions at will and unwind them when they want and at what price they want. And that matters because they don't do that like accidentally or kind of randomly. There is an internal trading desk at pretty much all these major exchanges that is there to make the exchange money. And that internal trading desk is trading against you. Now, Hyperliquid does this very transparently with their market maker vault, but every dollar that goes into their market maker vault as profit is $1 less in the hands of the users. Now, Hyperliquid, again, is way more transparent about this. And so, you can argue that like that vault provides liquidity that otherwise wouldn't be there. And that's a good argument. Like that, there's nothing wrong with that. So compared to say like Binance and, OKX, Bybit, et cetera, like way better, right? Categorically different. You don't need to have this like internal trading vault or like internal trading desk. So you can do it in kind of like a kind of, I think, honest way, but anyway, not important. I think Hyperliquid has like a major contribution there. So 1010, it's like these internal trading desks were losing money and they would just unwind you kind of, when and how they want. But they do this like all the time. I mean, not too long ago, like we had an account that was liquidated on one of the top 3 exchanges, lost like a large sum of money. And the reason it was liquidated is because there was like one position in the account. This account had like 15 positions. There's one position which triggered the liquidation. And we had been sending orders to unwind that position way before it got liquidated because it was just like inching up, right? And at some point they just stopped like fulfilling the orders. They're like literally just blocking the orders. Again, written in their system logs. It's not even like they have different logs, same logs.
So you can
and when
just
they liquidated us, yeah. It's like fucking export to CSV, send them an email, right? It's not like we both see it.
Yeah.
So, and guess what? When they liquidated the account, here's what they did. 15 positions. One of them triggered the liquidation. They liquidated 14 positions. Guess which position they didn't liquidate? The one losing all the fucking money.
Yeah.
We said but you can't sue them because when you agree to their terms of service, you're agreeing to the casino, and you can't like go into a casino, lose money at the roulette table, and sue them for trading against you. Like, that's not a thing, right? It's
So
like, no, dude,
just to clarify quickly, when you say casino, I think I heard you say, I mean, your thoughts on like casino versus a proper exchange, just mainly the fact like, okay, so I would say there's a number of like reasons why I think things are casinos, but your rationale is that in your mind, a casino, like, and which applies to a lot of these centralized exchanges, is that they are directly trading against you. Is that basically your?
Yeah, that's really the premise.
Yeah.
And with decentralized, with DEXs, and it's predetermined execution, typically with like public code, it can't trade against you. Not an option.
Okay, so then lastly though, just touch on circuit breakers again. So we have these things in TradFi, which basically means if the market nukes, they stop trading for a bit and let everybody get organized. This is a little bit more difficult. Maybe, well, first of all, we don't really have them in practice in crypto, at least not publicly. But the reason is, well, one reason is that liquidity is fragmented like across all these different venues. So, it's like, do you stop trading on Binance and allow it to continue on OKGo or Coinbase or whatever? And there's no like centralized clearing place like you would find on the New York Stock Exchange or, other stock, TradFi, fully regulated stock exchanges where everybody understands what happens when, the entire market just plummets in 5 minutes or whatever. So is that one of the reasons, like the liquidity fragmentation, but like why else don't we have these kind of like circuit breakers? Does it not really work with like decentralized assets?
No, I think that's a really good question. To be honest, I've been against circuit breakers for a long time because I'm sort of a free markets, let the market decide kind of guy. It's only after 1010 specifically that I was like, we need some fucking circuit breakers, because that was all like totally avoidable, right? If that had been like a normal market, when it started falling off a cliff due to a known vulnerability on the exchange, they would have paused trading.
Right. Wait. When you say known vulnerability, what do you mean?
Binance knew that they had the vulnerability.
Okay.
It wasn't but this is public knowledge. This isn't like me like, fucking public knowledge. No, and I know people, like I separately know people who reported the vulnerability to them weeks before it happened, but Binance's public statement is that they knew about it. So
okay. Carry on.
But what's crazy is that also their public statement, if you ask them, so they have to acknowledge that they knew about the vulnerability, I think because too many people knew is my guess. So they couldn't kind of lie about it. If you actually look at their public statement of when the vulnerability was exploited, the timestamp they give is 20 minutes after the market recovered. You can just draw a line. Like, I should show you this chart. It's like fucking hilarious. So
they basically just like fabricated this, is what you're saying, or at least the chart.
Like, okay, it's not subtle. Let me kind of fucking bring it up. I don't have their official statement in front of me, obviously. I can bring it up, but let me just kind of show you what I'm saying. Yeah, here it is, baby. I want you to tell me if you notice like a big red fucking drop. Okay, you do? Good. Here's what they did. Known vulnerability. It happened right here. You see the line?
Yeah.
Can I draw on this fucking chart? They're like, here's when the vulnerability got exploited. Do you see how this one isn't like especially representative of this like big fucking red line?
Yeah.
They're like, here's the timestamp. Sorry guys. That's their public statement, dude. Like, I mean, this is a little. I'm going kind of like off the fucking rails here.
No, this is good. This is good.
Binance 1010 public statement. All right, we can get back to the fucking interview, but like, you look up like their statements about when the exploit was, but they'll tell you like when the exploit happened.
When you talk about, so I heard you talk about there are like circuit breakers. They're just not really well known. And as a result, traders, trading firms, retail doesn't exactly know when these things might engage because they're all sort of behind closed doors on decentralized exchanges. Is that talk to me about that as a problem?
Yeah. So going back to kind of this example where we were liquidated in this account despite like sending orders, right? That's a fucking circuit breaker. It's just not acknowledged. If you stop trading, that's kind of, and centralized exchanges like do this. They will literally just do it. It's more common in the like thinner liquidity assets.
Yeah.
Because that's where the internal trading desk is going to has like much higher risk of losing money. But
That's when Adam
as you
goes
saw with
to like
1010,
literal
it
zero.
happens. Right. Yeah. As you saw with 1010, like it happens, you know, like when that's a risk, like that's how they handle it. World markets doesn't have ADLs because it's not actually necessary to manage risk on the exchange. In our view, like the proper way to do it is every contract is bilateral. So if like let's say you're long and I'm short, and the market, falls very quickly, and so you're long, so you lost money, and let's say that you don't have enough to pay your counterparty, then your counterparty takes the loss. That loss doesn't get like socialized amongst the whole exchange. It also allows you to like, the other interesting thing is, I like to ask people who at Binance or Hyperliquid for that matter determines the risk limits. Like, what's that guy's name? Yeah, nobody knows. Nobody's met that guy. On world markets, all of the risk parameters are on chain. So it's public, verifiable. And where this is especially interesting is at market equilibrium, because there's perfect information symmetry between the risk limits and the traders, like the exchange and the traders, or the DEX, they should actually kind of iterate towards market equilibrium. So that's kind of a kind of interesting nuance as well. And if you disagree with them, you can like swap your counterparty.
Let me ask you just like a more broad question. I think we got into the weeds, but there's interesting stuff in the weeds. So that's a good part. There's like I've now talked to a bunch of people building perp dexes, right? And everyone has something slightly unique, but it's obviously like a hyper competitive, and obviously it's because we've seen the success of perp dexes in the past, and this seems to be like one of the real product market fits here. How do you envision world markets distinguishing itself from Hyperliquid and Lighter and all of these others, and additionally centralized exchanges? Now I think you've sort of touched on now the ways to kind of distinguish or differentiate from centralized exchanges, right? And why you think that centralized exchange trading in general is probably not on the right path. But in terms of it's a lot of it, to me, appears as though it comes down to just liquidity, right? Like, can you get like a lot of liquidity? Totally. You quote very, very tight, and can you provide a good experience for both retail and then professional traders? Like, talk to me about like how you envision, sort of. Maybe also we can talk about like go to market and stuff, and then finally we'll get Hersch to say something. But maybe we can start there. Like, where do you see world markets being different, and like how do you envision capturing a large amount of volume and excitement?
Yeah, so we've talked a lot about the kind of the on-chain stuff versus off-chain. Let's talk a bit about the kind of how you make more money. So if you do the basis trade on Hyperliquid, you're likely to make kind of, if you're lucky and you do it really well, and like at most 8%, which is not the world's like sexiest return. On world markets, you can make 50% for a similar risk profile. I would argue a lower risk profile. And the way you do it is you start with $10, right? Let's say you're on Hyperliquid. You're going to take 5 of those $10 and you're going to buy eSpot. And you're going to take 5 of those $10 and use it as collateral to short ETH perps, because you need to margin your perps with your dollars, right? So, you can do the math on your return. It's, the funding rate times the perp position. And you're market neutral, but also like, you got to maintain that collateral, which is in dollars also the ETH. Okay. If you do the same trade on world markets, what you're going to do is you're going to, you start with your $10. The first thing you're going to do is you're going to borrow $90 from the lending market, which is fixed term, fixed rate. You're going to take all $100 and you're going to buy eSpot and simultaneously short ETH perps. A couple interesting things happen here. One, world markets understands that the perp and the spot net each other. And so because it's fully on chain and it can consider risk atomically as a function of state, it actually allows you to apply more portfolio leverage to a position which it knows is market neutral or like has low net market exposures. And so you're basically taking that difference between funding and lending rates, i.e. the perp and the loan, and you're multiplying it times your portfolio leverage. So that's how and I can even like kind of show you this. So this is actually live on MegaETH mainnet, although it's a private mainnet. This is the test ETH. All right, so the numbers here are a little absurd because our funding rate is way off, but the way the trade works is you can see in this table on the lower right, it's showing you each step. You're borrowing from the lending market, you're buying spot, you're selling futures. And although, this is showing like 1,000% return, it's actually more like 100% return, which is still like pretty damn good, right? So, at like a 30x leverage kind of thing. Maybe it's like a 150. So that trade like illustrates the core principles of the exchange and like what makes it interesting. There are many relationships that cannot be traded efficiently on chain because no market unifies perp, spot, and lending correctly. And when you do these trades on WCM, you profit from making these relationships more efficient and closing the arbitrage. What's really interesting is that if I go to our docs and I look at the capital sink, if you can see this table. If we assume, so let's say we launch the product and the lending market adopts like Aave's lending rates and the perps market adopts hyperliquid rates, right? When you do the arb I just described, the lending and the perps rates will converge to the middle, which is what you see in kind of like the blue column, which is like the next iteration.
Got it.
And when that happens, it actually introduces an arbitrage between our perps market and hyperliquid, which is funding arb. When you do that arbitrage and it closes, it reintroduces the internal arbitrage between the lending and the perps market, which is this like yellow column, right? And so with every iteration, it actually sucks capital into the venue. And capital doesn't want to leave because as soon as it leaves, it's worse off, right? Because capital is most productive on world markets. You could leave, there are reasons to leave. You want to trade meme coins, something we don't list, whatever it is, right? But from a capital productivity perspective, you're best off on world markets. And we're not the only people to recognize this, right? This is actually like a well understood phenomenon and is implemented kind of all over like pretty much everywhere in traditional markets. But we are, to my knowledge, the first to actually build it. And although I see now like half a dozen pitches a day pitching these principally like, this kind of functionality, I haven't seen anybody who's even like especially close to building it. And, we'll be live in like 10 days. So,
awesome.
That's kind of the unique out here.
Okay, Hersch, turn your mic on. Let's hear from you.
I finally get to speak. I was quiet for the entire duration of the podcast, but not a yap. Yeah, it's just any questions for me, Gort?
Yeah. So like what how did you get involved with world markets? What is your, I mean, obviously you're a non as well, so like disclose what you want, but like what's your background in crypto and stuff? And then what was the kind of motivation to start working alongside Lucas here?
So my background in crypto is not as extensive as Lucas's. So I just got into like sort of like during DeFi summer in 2020. I was online like 24/7. That's like 24/7, right? I saw people trading. My first sort of experience to crypto was Tezos, right? Which is like one of the worst coins to ever invest in. And learn more about blockchain stuff from like Tezos, like experimented with Ethereum, started like fucking hunting shit coins, right? The trenching, before trenching was ever a thing, was during like I think DeFi summer, and I'm pretty sure even before that, like prior to that. But yeah, I just got into crypto then, traded, worked at a few companies, and then sort of just met Kevin, our other co-founder at World Markets. And Kevin was like, "What are you doing?" And I'm like, "Nothing." And he's like, "Why don't you come work for us?" And I'm like, "Why should I work for you guys?" And they gave me the pitch, right? Lucas and Kevin gave me the pitch in our first call, and I'm like, "I'm sold." I'm like, "You guys are building something that has never been built before." I mean, it was implemented by a certain like exchanges, right? Like Binance, like how Lucas mentioned, right? But it was with their own assets. And I'm like, "Yeah, on chain, it's like it's never been done before." And I'm like, "Yeah, this is like really productive because like I want to make more money with like less money, right?" It's basically like that. It's like
Hersch
do
gets
more.
it.
Do more with your capital, right?
So what is your role? Like you just primarily shitposting on Twitter, which obviously I think is a
The CT
revered-
lead role, sort of there. Just like trying to come up with like go to market strats, whatnot. Just like think about ideas, right? With the team about like
Hersch is the Bob Dylan of shitposting.
Yeah. Okay, so
He has
what has
some
been
good
your
old
experience like
content.
with community building, if you will? Like what have you been working on? Like what have been your strategies? I ask because I think that I think you guys will sympathize with this. It does seem hard right now, right? Like I think that there is a massive supply of tokens and projects, and it is hard to stand out. So like where do you view yourself in terms of positioning, and like what has been your experience thus far?
So the thing now, it's right because like when the market stops going up, right, it's when the communities get their pitchforks and just like start headhunting, right? Like you guys got me to buy this, right? You guys shilled me this, right? I actually believed in the vision, right? It's when people get jaded, right? Especially now, because like they believed in the vision that was like sort of like shilled by the people they followed or the founders or like blah 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 or whatnot, and it's very hard to sort of like build a community, like especially in these conditions, because like people will join you as long as the markets are going up and you promise them like we're gonna give you an airdrop, tokens, blah blah blah, right? They'll stick around, but like what you got to do is like actually build a product in which like people will be like, yeah, I like using this product, right? I'm gonna like sort of like be a community guy for you, right? I'm gonna like tell others about like your product, right? And it's hard to do. I think Hyperliquid got really lucky because like Hyperliquid by itself, like at that time, was like a really good product, right? And given right the points farming and the eventual like TGE, right? Like I think in recent memory, the Hyperliquid's TGE was like one of like the largest wealth creations for a lot of people, right? It's like because a lot of people,
fucking amazing.
Yeah, and I feel like that's the sort of like the most important thing is like how can you give your users more money, right? Or give them a way to make more money, in my opinion, is sort of like the best way to go on about making a community now. Because like people before they didn't care, people speculated on the asset. Now they care about like, oh, are you guys doing buybacks? Are you guys generating revenue, right? They're looking at like PE ratios, right? Which is like people have never done before, right? And there's like a big shift in like in the community, like in the entire space as a whole. I think it's maturing a lot more, and people want actual real products now, right? Rather than just like somebody selling them like a fucking snake oil or like a pipe dream, right?
Do you trade perps?
I trade perps, even though I'm not profitable. I trade perps.
I think very few people are profitable, to be honest.
It's like my friends. They tell me do not trade perps, right? They tell me do not long anything or do not talk to girls. As soon as I talk to girls or like trade perps, they're like, it's over. It's over. Yeah. I remember. I think last year I opened a long position around like 90K or something like that, and the markets went down. The markets died, and it took almost a year for the markets to like come back to break even. And I'm like, guys, I held my position, and they were like, "What the fuck? Are you a moron?" And I'm like, "Yeah, I am."
Yeah, I mean, I sympathize. I also trade perps, but not seriously. And in fact, I kind of don't like. I don't pretend to actually consider myself a trader because
like to me, I'm not a profitable perps trader, but I like experimenting with like new platforms, right? Because like to me, I gotta know, right? If there's a DEX that is sort of like better than us or is doing a thing that's different than us, I want to like try it out and see like what are they doing that's better or like worse than us, right? Because it's part of like my job as well, and it's like part of the things I have done for so long. Because like I think the best advice I got was just try out everything, right? And I did that. Like this is how like I got into crypto. Like traded during Uniswap, right? It's Uniswap summer. I got the airdrops, right? I'm like, you get paid to test out things. I'm like, this is amazing. So it's just like it's just like what I've done for like the past like 6 years now. And I still do it, which is good.
What has been your experience with MegaETH? Like, you know, the being semi incubated, if you will, by the, I don't know, are you guys part of the, so I did this podcast with Brother Sister Bang, and then it got all messed up, the audio and stuff. I had to cut a bunch, and then we just didn't do it again. But I'll ask her to come back on.
Yeah.
But anyways, she talked a lot about this, kind of like incubating the whole little mega mafia. But I think there's like different groups within the mega mafia. Like some people are like full blown, projects like funded and sort of supported, and then there's others that are kind of more ancillary or whatever. Like where do you guys fall on that, and what has been your experience working with sort of a yet to launch chain? And I don't know.
So we're definitely in the center of that, and being the canonical DEX on MegaETH v2, I heard hopefully GG is doing well, but we've had a great experience, and so we have no intentions to leave the chain. Importantly, like I think the thing that people miss, particularly the app chain folks, is the purpose of a block. Like what a blockchain gives you is platform economics, which have been studied for like 20 years, by the way. Xbox, iOS, so on and so forth, right? And platform economics are powerful. In my view, the reason Ethereum has so much money on it, despite being like much slower, is platform economics. And what that means is it's this powerful network effect that locks capital in, which is exactly what you need as an exchange. What makes it incrementally more valuable is layering in functionalities. So for example, like let's say that somebody, we're an exchange, world markets. We need listings. And so the BRICS team and, the Mega ecosystem is doing FX and giving international access to assets and yield that is usually only available in these local emerging markets, super high returns. We need retail aggregators because like we're really good at security, liquidity, exchange infrastructure, but we're not the world's experts on UI, UX, or retail distribution. So Hit One, another mega mafia project, is building on world markets, and they're building arcade finance. So like fucking incredible, it's a fun app to use. They're from the Rollbit team, so they know their stuff. But you want to, play these games, you want to gamble, you want to take 1000x leverage, like Hit One is the place to go. And what MegaETH does, we need market makers, right? We need liquidity. MegaETH has brought all of that to world markets.
Got it.
They're basically an extension. And from their perspective, it's like they have this ecosystem. It just makes obvious sense to connect the projects. And when you layer in those connections, then it drives value for the platform. Because when somebody comes, to like a front end, let's say they, go to Hit One or whatever, but they go to some front end that's a mega project. If they click the button on the front end, that single user action may trade a MegaETH listing on a MegaETH DEX, with market makers profit. You see like these layers per unit of action on the user side, like create a network effect for like value and liquidity. And I think I think Mega and Solana are the only two ecosystems that like really understand that.
Well, guys, this has been fantastic. We've kind of gone a little bit over, but that's okay. I really appreciate it.
Questions or we're over, so I don't want to. Okay, so I gotta ask, like, what's your view on like all of this and maybe MegaETH and specifically? But I know that you, and I'm also like not like a Bitcoin maxi, obviously, but I do think like kind of praise the king, right? What do you kind of think of sort of smart, operating like on-chain smart contracts, and then something like MegaETH, which has this like very specific trade-off of like, centralization versus speed and kind of this like industry as a whole that,
First of all, I really should provide context when I talk about what my like own views are, because it is sort of important for my answer, which is that I don't allocate anybody else's capital, right? Like I just invest my own money. And so I'm also not a builder, or I'm not really associated with any projects. I mean, I have a sponsor for this podcast, but it's like a personal friend, right? So apart from that, I'm not really associated with anybody. And So, I mean, that does make a difference, right? Like when you're talking with VCs, like obviously, and I'm not even talking about just bag bias per se. It's just they are, required to allocate capital on a rolling 3 to 7 year basis and provide returns and provide exits. And I don't have to do that. And, ironically, I think with venture capital, they kind of talk about how they are patient capital and they're more patient than the retail pump.fund guys. But when I invest in something, but when I invest in something, I mean, I'm buying with the intention of never selling, like truly. So like when I buy Bitcoin, my premise is like, I'm going to hold this. And if I die with this, I die with this. And if Bitcoin dies, I'll take that loss, but I'm willing to take this risk. Right. So like that does make a big difference because I'm not forced to try to find the most innovative trends or I'm not like there's no requirement. Right. So sometimes I try to, whether or not I'm good at it, I don't know. But the point is just like, I do have a different perspective. As for, mostly my view on crypto is like, I've watched this space really evolve. And, I think with regards to trading, it's like, I don't know that we decentralized NASDAQ, but we did create a bunch, we created 100 centralized NASDAQs that now have to compete. Right. But maybe that competition aspect is good. I think that I'm less, like I said, like I don't really trade seriously, not the way that you traded seriously. So I don't have as good of a read on, okay, Binance is like screwed in the long term, or even the New York Stock Exchange has all these inefficiencies, or, the CME, right? Like to me, I don't deal with like the base level architecture and seeing where there can be innovations. And so from my perspective, it's like, yeah, I'm sure there are a lot of inefficient systems within TradFi. And I definitely agree that there's, interesting aspects of a unified layer where you can move assets around and be composable and stuff like this is not lost upon me. It's just when it comes down to like 0 to 1 unlocks, I don't have as good of a perspective on that. So I kind of have to trust the people who I think are smart. So but I do think there are smart people working on this. So that does make me inclined to believe that there are innovations to be had, right? With trading with on-chain or smart contracts or what it may be. So that's a very long sort of, this is my, overarching context. As for, MegaETH, I think they are skating to where the puck is going. It's like the most cliche VC term in terms of realizing that there are massive advantages to centralization and speed, and maybe those trade-offs are worth it. Like with L2s, the idea of unilateral exits and sort of still being able to access your funds. I don't know what this looks like in the long run, but maybe it is a big advantage, right? Like maybe the fact that you can force exit, for example, when this stuff is sort of implemented, is a big unlock. But I don't know exactly like where the value, accrues. My instinct is probably more with like, if I've watched Hyperliquid make a lot of money. So I think that if you can own the users and own an area that generates a lot of fees, that you can create a good business. As for like the chains themselves, like I'm, sort of inclined to think they end up more as back office infrastructure for projects like yours.
Yeah, right.
So, I think it's really like going back to what I was kind of asking Hersch and, just talking about the general sentiment right now. I think it's hard. I think there's been it kind of has felt like euthanasia roller coaster for the past 5 years, It really has. And it seems like there's kind of diminishing returns. I mean, especially at the infrastructure layer, right? I think this seems lost upon people, maybe people who weren't around last bull market, but like you and I and like Hersch, I'm sure, like we recall when Avalanche went to 100 billion FDV, right? You know what I mean? And now Monad, which it probably has, 10 times as good of tech,
incredible.
Is treading water at its right below its ICO price of 2 billion FTV, right? Like that's, and I mean, of course, we're talking FTVs. Of course, we're talking Suzu and Kyle yeeting not their own money into markets, and SBF yeeting not his own money into markets, right? Like, it's not lost upon me that that was an anomalous time. But just like, if you zoom out for a second, it's clear that we're not like peaking at similar, valuations or similar excitement right now. And I think, of course, like AI has taken a lot of that. I think that's also, it's probably like partially a cop out. Right. No, right. It's almost, it's, I think it is a good thing. It's also been like much more valuable. The value has been realized much more quickly with LLMs. Like, regardless, I'm not trying to, say that AI is so much more important than crypto, but just like in terms of practical usage.
Yeah, don't worry. I'll say it for everybody. AI is more important.
Yeah. Well, it's just the normal person like gets it very quickly. They have like a superhuman able to answer anything for them and help them with workflows and coding. And whereas crypto is more esoteric and still like the use cases are still kind of, out there. So I don't know. I mean, I think, but I will say, I think it's a little bit of a cop out to say that like AI, I mean, it has sucked all the risk capital out, but like if the risk profile was extremely good in crypto, it would still be here. Right. Exactly. So, I mean, I think we just have to be comfortable with, and maybe this changes. I don't know, but there does seem to be kind of like a malaise right now, and it's hard. Like you can be building the most innovative, project in the world right now, and it's just hard to get attention. It's hard to like capture and retain that. So I don't know. I mean, I don't have anything else to do, so I'll be sticking around. But it's interesting to watch, right?
Yeah. Is there anything that like does excite you, or kind of like North Star, or maybe like a small kind of light on the hill in a kind of otherwise dark room?
Yeah, I mean, I'm still like, I'll always be hyper bullish on Bitcoin. And again, if it fails, it fails. Like, I'm willing to just die on that hill, right? So that's something that to me, I'm always like, I really do believe deeply in like a store of value for anybody in the world that is accessible on a phone, right? And like that is like really powerful to me. Stable coins are obviously extremely useful, but they don't excite me. Like, that's not what excited me about crypto initially.
That's a connection with like electricity to value, right? It's like somebody has some shit wrapped in a bank account,
right? And so I mean, I do think a lot of the trading and DeFi applications, I don't know what kind of comes out as winners. I think prediction markets are interesting. I was pretty cynical about, well, I guess I'm still cynical, but I think they're pretty cool. Like, Polymarket has grown on me. I think it is an interesting platform. I think there is information that comes out of these. And I also, maybe one thing about prediction markets that I think is interesting is, and I was talking to like I call him my quant, like a kid who I think is really, really bright. And he was saying like one thing that he's observed that's interesting with prediction markets is that the amount of like liquidity and volume needed to kind of come to a fair price is actually less than you would expect. And because my intuition is like, look, okay, you get these VCs bragging about Polymarket and there's like $500 of volume, right? And there's not much to glean from a market where $500 of volume has been traded. It's like, okay, there's no signal there. But interestingly, I think that I've been surprised now talking with smart people who are saying, prediction markets actually probably need much less liquidity and volume than you'd expect to kind of bring information to the forefront. And so that's kind of interesting to me. I don't know. I mean, I'm following along. Like I said, I'm always going to be hyper bullish Bitcoin. I think that I'm optimistic about a lot of the rest of crypto, but I don't know exactly like where we go from here.
No, that makes total sense. Yeah, I agree with those points.
Yep. All right, guys. Well, this has been awesome. Good luck. Likewise. Where can people find you? Hersch, what is your Twitter handle?
It's at WCM_Inc.
Okay.
We will change it later. Okay,
cool. And you guys are launching
that's the website too,
WCM the next month or so? Launching the next month or so?
We're launching in like 9 days, dude. We got shit to do over here. Yeah.
Okay. Awesome. All right. Well, thank you guys for coming on. Maybe we can follow up in 6 months, see how it's going. But great. Appreciate it.